right, let's get right into it. We all know that HMOs and property conversions can be, well, insanely profitable. But there's a flip side, right? They can also be total deal breakers for most mainstream lenders. So that leads to the big question. Can you actually use bridging finance for these kinds of projects in the UK? To buy, convert, or even refinance them? And the short answer is, yeah, sometimes. But, and this is a big but, it all comes down to the rules, the risks, and just how hungry a lender is for that specific deal. And this slide, it just nails that core tension perfectly. On one side, you've got the potential for these fantastic rental yields. But on the other, you're dealing with projects that high street banks just, well, they won't touch them. This is exactly the gap that bridging finance is designed to fill. But make no mistake, it's a high-stakes tool. It comes with some very serious rules and risks, and that's exactly what we're going to break down today. Okay, before we go a single step further, we've got to do the important disclaimer. So listen up. This is purely for educational purposes, okay? It is not, I repeat, not financial advice or a recommendation of any kind. Bridging finance can be expensive, and look, your property may be repossessed if you don't keep up with repayments. And another thing, if you're using unregulated bridging, you generally won't get the same FCA protections as you would with regulated lending. So the bottom line is, always get independent legal and financial advice. Right, so here's the plan for this explainer. We'll kick things off with what bridging finance actually is in this world. Then we'll dig into why HMOs so often end up needing it. After that, we'll get into the 5 crucial questions every single lender is going to ask you. Then we'll see it in action, cover the risks you absolutely cannot ignore, and we'll wrap up with a practical checklist to help you frame your project for success. So first things first, what exactly are we talking about when we say bridging finance? Well, put simply, it's short-term funding. It's a tool that's all about speed and seizing an opportunity, especially when a deal has to happen way faster than a standard mortgage could ever manage. In the world of HMOs and conversions, it pretty much always boils down to a simple 3-step dance. Step 1, you use the bridging loan to buy the property, usually one that a normal mortgage lender wouldn't touch with a 10-foot pole. Step 2, you fund all the work, the conversion, the refurbishment, the whole shebang. And then step 3, and this is the most important part, you exit. That means you pay back the loan either by selling the property for a profit or, and this is way more common, by refinancing onto a proper long-term HMO mortgage now that you've added all that value. Okay, so that's the what. Now let's talk about the why. Why on earth do so many of these really promising HMO and conversion projects need bridging finance to get off the ground? Well, it really just comes down to all those situations where a standard mortgage lender just throws up their hands and says, nope. And these are the usual suspects. Maybe the property is considered uninhabitable. It's a complete wreck or needs some serious work. Or maybe you're planning big layout changes, like adding bathrooms, fire doors, moving walls, or totally redoing the electrics and plumbing. It could be an option buy, where you're up against that classic 28-day completion clock. Or you're doing a change of use project. And let's be honest, standard lenders just don't like that kind of uncertainty. Now, this is a really, really important point. I cannot stress this enough. Planning rules, licensing rules, they can be wildly different from one local council to the next. So please, the crucial takeaway here is to never, ever assume. What works in one town might be a total non-starter just down the road. You have to check. And having that local knowledge is key, which leads us straight to the lender's point of view. In theory, yeah, you can absolutely use bridging for these projects. But a lender saying yes always comes with strings attached. They need some serious clarity before they'll even think about funding your deal. And really, it all comes down to 5 key questions they need answered. If you can get these 5 areas totally buttoned up, you go from being just some hopeful applicant to a serious, credible proposition. This is what's going to put you in a much, much stronger position when you talk to them. First up, what's the property and what's its end use? Lenders need to know exactly what they're getting into. Is it already an HMO? Is it a regular house that you're going to convert? Or are you just reconfiguring the layout? And critically, is this definitely 100% for a business purpose? Second, and this is a huge one, what are the local licensing rules? This is where so many deals get completely bogged down. Is the property even in a licensing area? Is it going to need mandatory licensing because it's a large HMO? Or is it caught by one of those selective or additional licensing schemes that councils love to bring in? You need to know this stuff inside out. Third on the list is all about planning. The work you're planning to do, is it covered under permitted development rights? Or are you going to need to go through the whole process of applying for full planning permission? Any gray area here, any uncertainty, it makes lenders really, really nervous. Number 4, what's your build plan and your budget? Let me tell you, lenders absolutely hate vague plans. They need to see a proper, clear scope of works, they want a detailed breakdown of realistic costs, and they want to see that you've built in a sensible contingency fund, because let's face it, things rarely go exactly to plan. And finally, number 5. Honestly, this is the big one. This is the question that the whole deal hangs on. What is your exit strategy? You see, a bridging loan is, by its very nature, temporary. It's a short-term fix, so the lender has to know with crystal clarity how you're going to pay them back. Are you planning to flip it and sell? Or, like most people, are you aiming to refinance onto a long-term HMO mortgage? And if refinancing is your plan, hope is not a strategy. You've got to show them the path. You need to prove that you're going to hit the numbers, the affordability, the new valuation, the rental income, once all the dust settles. And this quote just sums up their entire mindset perfectly. Bridging lenders are built for speed. They can move incredibly fast to get a deal over the line. But they do not fund chaos. They fund well-planned, well-thought-out projects. Period. So, keeping those 5 questions in mind, let's take a look at a few common scenarios you see all over the UK where bridging finance is often exactly the right tool for the job. You've got your classic unmortgageable purchase. A place with serious damp, maybe some structural issues, or it's missing a kitchen or a bathroom. Then there's the auction HMO, where you need that speed to complete the purchase and you need the cash for a light refurb. It's also perfect for that really popular refurb-to-rent strategy, where you're creating new lettable rooms before you exit onto a mortgage. Or maybe it's a big reconfiguration job, turning a large family home into a proper HMO layout. You even see it used for mixed-use conversions, where bridging can tide you over while you're waiting for all the legal or planning stuff to get sorted. Okay, now for the section that most people tend to skip over, but it's probably the most important part of this whole explainer, the risks. Look, bridging can get you the keys to the property, but if you mess up the project, things can get very expensive very, very fast. And these are the cold, hard financial realities. The interest is usually charged every month, and yeah, it can be pretty high. You've got a ton of fees to factor in: valuation fees, legal fees, broker and arrangement fees, and sometimes even exit fees on top. Delays will absolutely kill your profit. If your refurb runs over schedule, those holding costs just climb and climb. If your exit plan falls through, you can't sell or you can't refinance, you're stuck paying that expensive interest rate. And of course, the ultimate risk. If you fall behind, your property can be repossessed. So this is the key takeaway. This is precisely why you need a completely watertight, totally realistic exit plan in place before you even think about starting, not halfway through when things are already going sideways. So, knowing all those risks, how do you protect yourself? How do you actually set yourself up for success? Well, if you're looking at an HMO or a conversion and you're thinking bridging might be the answer, this checklist is your game plan. This is what you should be going through point by point with a professional advisor. Number 1, nail down the purchase price and get a realistic end valuation. 2, have a super detailed scope of works, a clear timeline, and a budget with contingency. 3, get the licensing and planning situation sorted, no ambiguity. 4, get your hands on solid evidence of what the expected rental income will be after the work is done. 5, know your exit route inside and out and all the criteria you'll need to meet. And number 6, make sure you've got a clean legal route with a solicitor who knows what they're doing in this space. So if you're undertaking an HMO or conversion and you want to explore unregulated bridging finance for a business purpose project, you can get in touch with ExpertBrokerUK. And just one last time, please remember, this is for educational purposes. Bridging is a high-risk strategy, it can be very expensive, and your property may be repossessed if you do not keep up with your repayments.